Welcome to This Explainer. Go ahead and take a deep breath, settle in, and maybe just let your shoulders drop a bit. Today, we're stepping away from the flashing indicators and the sheer, overwhelming noise of the financial space. We're going to have a calm, really honest conversation about the psychological reality of the charts. We're talking about emotional discipline, operator development, and the quiet, unglamorous truth about what professional execution actually feels like.
Trading emotionally is like trying to drive faster through fog. Just let that sit for a second. It's a perfect metaphor, isn't it? Because we've all been there. You hit a patch of uncertainty in the market, panic starts creeping in, and instead of slowing down and getting your bearings, you slam on the gas, desperately trying to get through it faster. And what happens? You crash. It's a harsh reality to face, but in the markets, the trader who clicks the mouse the most usually makes the least. We're conditioned to think more action equals more results, but under pressure, action without clarity is just self-destruction.
So, why does doing less feel like failing? It's a profound question. Well, it's basically a neurochemical trap. Think about it. In almost every other aspect of our lives, our jobs, our fitness routines, our brains are hardwired to equate action with progress. Hard work equals a reward. But the market totally inverts this reality. When you're sitting on your hands, watching the charts, doing absolutely nothing, your brain starts screaming at you that you're falling behind. And I completely validate that frustration. It feels awful. But the truth is, doing nothing is actually one of the highest skill activities in this entire business.
Okay, let's dive right into this. Section 1, the participation trap.
I'll be completely honest with you. I used to get this so wrong. I used to treat the market like an extreme sport, sweating over my keyboard, heart rate hovering at 120, chugging cold coffee just trying to scalp some minor reversal, all because my brain simply couldn't stand being on the sidelines. That urge to catch every single move is undeniably the most expensive habit in trading. But professional execution feels more like chess than adrenaline. If your palms are sweating, you aren't executing an edge. You're just paying the market for very expensive entertainment. Professional execution is highly calculated, deeply structured, and yes, somewhat boring.
That brings us to a crucial paradigm shift. Section 2, retail versus institutional thinking.
We really have to shift our perspective from being a hunter who shoots at everything that moves to being a filter. The contrast here is massive. Think about retail thinking. It's entirely focused on predicting direction, seeking emotional validation, and living or dying by the outcome of a single trade. It's just a constant state of hoping and praying. Now contrast that with the institutional mindset. They honestly don't care about being right. They care about managing risk, process integrity, and pure survival. They are completely, ruthlessly process-driven.
And this leads us to a truth that might sting a little, but it's incredibly liberating. If it feels boring, it's right. I know that goes against literally everything you see on social media. You kind of have to laugh at it, right? The whole Lambo lifestyle, the hype, the motivational yelling, it's all a mirage. In reality, that hype is exactly what destroys funded accounts. The true professionals are not banging pots and pans on the internet. They are quietly, boringly executing a repeatable process day in and day out.
Which leads perfectly into Section 3, discipline over dopamine.
Because overtrading isn't a strategy problem. You don't need to go out and buy another indicator. It's biology. Let's walk through exactly how this neurochemical sequence plays out in real time. Step 1. Pain. You take a stop out, and it physically hurts. Step 2. Urgency. Your brain hates that feeling of pain, so it demands a quick dopamine hit of recovery to relieve it. Step 3. Overtrading. You start forcing a trade that isn't really there, just to get that chemical relief. And step 4. Account destruction. It's a vicious, predictable cycle driven entirely by brain chemistry, not logic.
Overtrading is often an attempt to escape discomfort. I want you to just pause and really think about that for a moment. Think back to the last time you went on tilt. Were you genuinely seeing an A+ setup forming on the chart, or were you just desperately trying to escape the awful, sinking feeling of being in the red? It takes some massive amount of psychological maturity to admit when we're just forcing a trade to feel involved, to feel like we're fixing a problem.
But you can't just tell yourself, hey, I'll try to be less emotional tomorrow. It doesn't work. You need a hard, quantifiable metric. And that's exactly where the 7 out of 10 rule comes into play.
We call this the emotional neutrality baseline. It's a completely honest, self-assessed state of your own mental clarity. If your emotional neutrality drops below a 7 out of 10, maybe you're angry about a previous loss, maybe you're overly euphoric from a massive win, or honestly, maybe you're just exhausted. You simply do not touch the keyboard. When you drop below a 7, your brain literally cannot self-regulate.
You cannot trust your own real-time judgment, which means you need this hard mechanical rule to step in and override your dopamine craving.
Moving into the core framework. Section 4, the survival hierarchy.
So, if we're actively choosing not to chase dopamine, what are we actually doing out there? This is the core hierarchy of a professional operator. Survival first, risk control second, process third, and profit last. Notice exactly where profit is on that list. It's literally at the very bottom. Most of us start our trading journeys with profits sitting right at the top, and that's exactly why we fail. You have to internalize that protecting your mental capital is just as vital as protecting your financial capital. Because without survival, both financial and emotional, the rest of this hierarchy completely collapses.
The market exposes emotional leaks under pressure. It's a heavy truth. The market is a remarkably efficient, incredibly ruthless mirror. If you have a crack in your discipline, a tiny leak in your emotional regulation, the sheer uncertainty of the charts will find it and tear it wide open. It's exactly why you can be perfectly disciplined for months in a simulator, but the second you're trading live capital, you fall to pieces.
So how do we defend against that? Section 5, selective participation and timing. Let's map out how this actually builds. The market might be technically open all day long, but your specific edge, it's only present for a tiny fraction of that time. Imagine a strict time-based framework for a typical hourly session. The first 0 to 12 minutes, that's accumulation. Absolutely no entry. From 12 to 20 minutes, that's manipulation. This is Trap City, where the risk of revenge trading spikes highest. You only actually want to execute in the 20 to 45-minute distribution window. And I will fully confess, sitting on my hands for those first 20 minutes used to physically ache. But that restraint, that is the edge.
Because patience creates precision. Only timing survives the noise. Doing nothing while you wait for your specific predetermined time window isn't being passive. It is a highly active, highly aggressive defense of your capital. Selective participation is the active discipline of protecting your edge from your own worst instincts.
And that brings us to our final point, Section 6, redefining market consistency.
So the crucial takeaway here is that a professional knows exactly when the day is done. They define it in advance using non-negotiable operational anchors. If the clock hits 12 p.m. Eastern, hard close. Hit your $500 daily loss limit, stop immediately. Primary theses completed for the day, session over. Take a stop out. That automatically triggers a mandatory 20-minute pause to let the dopamine flush out of your system. You do not negotiate with these rules in the heat of the moment when your brain is begging for just one more trade. These rules protect your money, yes, but far more importantly, they protect your mental clarity for tomorrow. Ultimately, we have to fundamentally reframe what good trading feels like. Consistency is absolutely not the guarantee of a daily profit. It is behavioral repeatability under uncertainty. Can you execute the exact same mechanical process and follow the exact same rules regardless of whether your last trade was a huge win or a painful loss? That is true consistency. It's about being hyper-focused on the process rather than staring at the P&L. And look, you aren't alone in this struggle. Every single professional operator has had to build this exact same emotional armor.
The market will always offer a trade. It will always present something that looks incredibly tempting. But your true growth as an operator is measured not by what you take out of the market, but by what you have the strength to leave behind. So I'll leave you with this to ask yourself before your very next session. Are you trading your edge today, or are you just trading your dopamine? Thanks for joining this explainer. Protect your mental capital out there, and we'll see you next time.